A very good morning to everyone. Bangalore Valuers Association has organized a 2-day residential workshop, which is happening now. But this program, the management committee had to decide whether we are having this online session or not. Thanks to our Vice President Education, Mr. Ravindranath, who has organized a workshop, physical, and even this online session. We do not want to miss the tradition of the second Saturday and fourth Saturday, early morning, 7:30 to 9:30. We want to follow this as a ritual. And yes, we are having today's session. I request Kusum to introduce formally today's speaker.
Thank you very much, Shilpa. Very good morning, all the participants. It is my privilege to introduce Mr. Anurag Singhal. He is a chartered accountant. He is a registered valuer. He is also an MBA. He is having over 15 years of experience in various Indian companies, as well as now with multinational companies like ITC, Tata Steel, and Aditya Birla Group. And he has he is running his own firm now for about 2 years. He specializes in valuations, financial modeling, financial due diligence, and he also provides CFO services to startups, SMEs, and investors. He has been a guest faculty at various RVOs, Valuation Standards Board, ICAI, IIMs, as well as various B schools. Now, let us just take a quick minute to understand what he is actually going to deliberate upon. So the role of financial reporting in the overall growth and development of an economy is very significant. The era of the globalization as well as liberalization led to increased social mobility. It also led to cross-border movement of finance, capital, as well as commodities. All these things in turn necessitated a single set of high-quality global accounting standards. With the emergence of such high-quality principle-based international financial reporting standards, which is IFRS, in the global accounting scenario, this IASB has set up this IFRS. There was a need that was felt to converge these Indian accounting standards with these updated high-quality IFRS. This adoption of this convergence with IFRS brought about transparency, accountability, and efficiency in the financial markets, and served the public interest by fostering trust, growth, and long-term financial stability in the global economy. Now, Mr. Anurag Singhal, in today's session, he is going to compare, particularly with relating to ESOP valuation frameworks, what is the nuances as per IGAAP, as per Ind AS102, as well as ASC-718 as per US GAAP. Mr. Anurag, the session is over to you for your deliberation. We look forward to hearing from you, sir. Thank you so much.
Okay, ma'am. So, good morning, everyone. And what we are trying to cover today is first the basic concepts around ESOPs, like what are they and why they are important. Then we are going to talk about the accounting framework, how that varies under the Indian GAAP as compared to the Ind AS as compared to the US GAAP. So, yeah. Yep.
Mr. Anurag, we had a couple of sessions on ESOP. So you can just move across on the fundamentals and then you can slightly
basics
touch.
part only what I will teach.
Oh, okay.
I'm just opening my PPT. There are so many PPTs. Yeah. So what is ESOP and all, how that incentivizes people and all? These are things I think which are mostly covered in multiple sessions. So what we will talk about today will be more around how they are accounted for under IGAAP, under Ind AS and under US GAAP, and what are the practical challenges that are involved in actually getting them, and how as an individual. So now what happens is that this ESOP valuation space is mostly dominated by the Big Four in terms of they are either doing this complex ESOP valuation or they are doing the audit of the client who will get this ESOP valuation done from you. And hence, the moment you come across as an individual practitioner, you need to up your sleeves and ensure that the top end work is done so that the auditors, generally you will see that there is like a bias against or towards, I will not say what, but as an individual, one tends to feel that, oh, these guys will not be able to do that. You are a small four kind of a firm. So from that perspective, it is important that we do the accounting properly. So what is ESOPs and all, this is fine in terms of retention and all. Now the point is that when it comes to the key features of ESOP, the critical part here is that this is an alternative to paying high wages to the employees. Which means what? I would have booked salary in my books of accounts as compared to booking the salary. I am granting an ESOP. And hence, it is important from an accounting perspective that employee-based compensation, performance-based incentives or any sort of a compensation that you're giving to an employee by dint of ESOP should be accounted in the books. Now, yesterday, for example, someone called me and said that they are having an ESOP buyback in their company, and he is saying that this is going to be taxed as income from salary, and he wanted the rationale why it is not taxed as income from capital gains. So if you look at the typical criteria, we'll cover that. So there are three parts here. Like one, we have the grant where you receive the right. So I join a company, good things happen in the company, or for example, by dint of the employment letter, the grant happens to me. Now grants will happen typically when it will happen like 25% after 1 year, 25% after year 2, 25% after year 3. So from that point of time, I get into the vesting zone. So now they have vested in me. And in fact, vesting is the point of accrual for the accounting to happen. It is that point of time where the company has to take the charge in the book. So a lot of people get confused that in terms of vesting, like how many options have vested during the year, that is very critical. What will be the fair market of the option? It will be on the date of grant. But how will that, for example, if I am doing a grant and I have to then amortize it over the period of 3-4 years, there are two options. I can have an accelerated vesting method, or B, I can just follow a straight line method, and we'll come to that. So the grant date is important from a Black-Scholes model's perspective because we calculate the fair value of the option as on the date of grant. But the accounting will happen, the proportion of that accounting will happen because of as per the vesting period. Now, this person does not exercise the right. So how the taxation also will change, that in case you have exercised your vesting, you've paid the money. For example, I say that, okay, my employees will get those shares at ₹1. Then the shares come into your DP account and then you sell them off. Then it will be a capital gain. But for example, most of the companies, what happens is that because employees don't want to pay tax upfront, that becomes a big challenge because that of the illiquidity surrounding options. So that's a startup, for example, an Udan. You would have thought that you are sitting on hundreds of thousands of crores of ESOPs. But suddenly what happens is that company is not doing well and then there's a down round, etc. Same has happened with Farmeasy, etc. Or in Byju's, for example, also Byju's from a pre-money valuation of some $20 billion plus now stares at, as far as the rights issue is concerned, is at $25 million is the kind of a pre-money valuation for that thing to have happened. So then people don't exercise the right. In that case, if the buyback happens, that will be taxed as income from salary because it is like a quasi-perquisite. Now, as far as the relevant statutes are concerned from a valuation perspective, also there will be Companies Act and Companies Rules. There will be FEMA, Income Tax Act and SEBI, depending on whether it is listed or not. So employee, it's an option. See, please remember that's an option. So when you are giving an option to someone, what will happen to that option? Either it will get exercised or it will get lapsed at the option of the employee. Or if the employee leaves the company, then in that case, it will be forfeited. So that the things that will happen with the ESOP is that it will either get exercised with the employee, it will get forfeited if the employee leaves, and for example, and some bad blood he's leaving, or the company cancels the ESOPs and gives you money in return. It becomes like a income from perquisite. And then there is very interesting thing called ESOPs now, which the valuation of ESOPs is actually very complicated, and I will try to cover that in some way. So as compared to employee stock option scheme, as the name suggests, ESOPs will be when the management of the company, the top founders, And the incentives there will be if EBITDA is more than 5% in FY27, then in FY27, this many shares will vest into them. So they are granted purely on the basis of performance. Now, ESOPs mostly are unconditional. So the moment you grant an ESOP, the liability arises. So as and when they will vest, the whole accounting happens. But in case of MSOPs, the thing is that they will come into the picture only if those targets are met. But today, you'll have to simulate based on past events, based on your understanding of the future, that what could be the likelihood of that event happening. For example, EBITDA greater than 5% in that startup in FY25, in FY27. If that happens, the founders or the top management get, let's say, 1,000,000 shares. Today, you'll have to do Monte Carlo simulation and come to the probability of that event happening. And accordingly, you have to take the charge in your books of accounts. So their vesting durations and lock-in periods will be different for different people, different companies, of course. But Monte Carlo simulation will be put there. And then as I told about employee ESOP buyback, so discounts under ESOP are an employee cost should be allowed as a deduction over the vesting period in the hands of the issuing company. And then at the time of exercise, the provisional deduction amount previously claimed during the vesting period shall be adjusted. So that is how it is. And if there is a buyback, so as section 1034A, any income arising to a shareholder, including employee ESOP shares on account of buyback of unlisted shares shall be exempt in the hands of such shareholders, and tax at the hand of 20% shall be paid by the unlisted company on the buyback of its shares as per section 115 QA. Okay, so this is how it is. So now, if you compare, like there are different guidelines here. Under SEBI guidelines, what is important here is that SEBI employee stock option scheme and employee stock purchase scheme guidelines 2014 are there. They are applicable only for listed companies. And what is the emphasis? Whether it is fair value or intrinsic value accounting, either of them. And there is actually material, not much of a difference between fair value and intrinsic value. It is just accounting terminology from a practical perspective. And then there are mandatory disclosures of the fair value impact. And we will look at an annual report of Infosys to understand how exactly those guidelines, as per the SEBI and the Companies Act, are there, that the listed company will have to make a disclosure in their annual report around how many options are granted and etc. etc. In IGAAP, now there are a lot of companies still for whom Ind AS does not apply. What is the criteria? If I were to just ask people, for Ind AS, what are the three criteria for people? If anyone can tell in the chat box. What is the criteria under Ind AS that a company will have to do then accounting? For example, here also the Ind AS. So a lot of startups will come and tell you that, okay, Ind AS is not applicable to us. And in some years, you'll get the assignment that, okay, this year we are migrating to Ind AS, and hence we will do a proper accounting as per the Ind AS 102 for our employee stock option plan. So what is the difference here? Anyone? When does Ind AS come into the picture for any company? There's a condition on net worth mostly that is followed. No one?
I think, it is. I'm sorry if I'm echoing.
Sorry?
Just 1 second, please. So the requirement is, am I?
Yeah,
am
yeah,
I
yeah,
audible?
audible. Yeah, yeah.
Yeah. So I think the requirement is that the net worth should be more than 500 crores.
250.
Is that correct?
250 crores.
250 crores. Okay.
Yes. So you will see that a lot of companies will be transitioning into that net worth. Suppose they have raised another round of capital and hence the net worth has increased. So from this particular year, the Ind AS will apply. So under IGAAP, still accounting for grant of options of this guidance on accounting for share-based payments. As compared to that, Ind AS, it becomes far more complicated. And then normally what will happen is once Ind AS also comes into the picture, they will also move to Big Four auditors, because by the time a startups a startup will be moving to 250 crore kind of a net worth thing, it would have a series B or series C. So by that time, then the mandatory requirement will also come that we must have a big four into our books. So you have a guidance note on accounting for share-based payments. You have Ind AS 102. Then you have IFRS 2, which is for both listed and non-listed companies. And then for US GAAP, it is ASC 718, again for both listed and non-listed companies. So you have the fair value accounting and disclosures. So this is the broad framework under which it is done. So if you look at it practically as compared to Ind AS 102, ASC 718, only the disclosures differ. But otherwise, the broad methodology is the same as far as computing accounting charge is concerned.
I just have one question. So with
Yes,
respect
please.
to the net worth that we spoke about, it is 250 crores even for an unlisted company, right?
Yeah.
And if it is a listed company, then it is 500 crores. Is that correct?
I am not sure about the listed criteria because most of our
Okay.
clients are unlisted.
Okay. So my understanding is that more than 500 crores, then obviously it has to be followed.
So like in one case, we got the assignment because the startup had crossed 250 crores of net worth in this year.
And it
So
is a
hence,
private limited company.
yeah, there's a private limit. Most of the startups will be private limited companies. They are not listed. So because of that.
Okay, sure.
So as per para 10 and 11 of Ind AS 102, equity settled share-based payments are required to be valued on a fair value basis as on the date of the grant of such option. So please remember that becomes a very tricky thing. It is on the date of grant. So during the year, there will be multiple grants that will happen during that year. And on each grant date, you will pick up the fair value of the option. Now that becomes kind of a mechanical task, but it becomes quite prolonged also because let's say there are 500 grants during the year and they are happening at different dates based on employee joining. So then you will have problem is that you will 250 crores. An unlisted company with a net worth of 500 crores are required to be complied with Ind AS. Achha. So fair value is equal to the intrinsic value and which is the market price minus the exercise price. So fair value and intrinsic value, what is the difference? Fair value, let's say of a share is 100 rupees and the exercise price is 1 rupees. So then what is the intrinsic value? It is 100 rupees minus 1 rupees. And then the difference is fair value therefore, and then it is the time value of money, potential gain in the share price. So that becomes the fair value of the stock. How do you compute the fair value of an unlisted stock? That also becomes the task here because it's an unlisted stock. So there are three methods, discounted cash flow, then GPCM, which is public company multiples, general public company multiples. And then you can have net asset value. Net asset value will mostly not work here because in the case of startups, the net worth of most startups will be negative in a way, or it will be very minuscule. So then as on the date of grant, so that is why I'm again emphasizing as on the date of grant of such options, you will have to compute the fair value. Now that practically will be over a 6 months period. So all grants that will happen between 1st April and 30th September, that will be covered by a single report because it is not possible that during the year there'll be so many grants. How do I compute the fair value as on each of those dates of the grants? So then that 6 months window, normally you should be able to manage with your auditors. So some people become very theoretical and try to do a lot of stories, but normally that will be there. ESOP expenses are recognized as a charge to the income statement over the vesting period on a straight line basis based on number of equity instruments that are expected to ultimately vest. Now that's a very interesting thing. On a straight line basis, so basically if let's say 4 years are there, so every year as and when the employees are that vesting period is happening on a straight line basis, I will recognize that as a charge to an employee expense. But then based on the number of instruments that are expected to ultimately vest, which means what? If I'm expecting that there'll be a 20% attrition in the company, then in that case, that 20% attrition will have to be factored in while we do the accounting charge. And therefore, that leaves a lot of subjectivity in the hands of the company also. That now what is, how would you calculate attrition? Attrition can be based on the past data. Now in the past data also, if you calculate attrition on the basis of annualized, like April, May, what is the opening number of employees? and March mein what is the closing number of employees, and then accordingly if you do additions and exits from the company, you'll get a different number of the thing. If you do a monthly attrition, because there'll be periods where monthly there'll be spikes, and then annualize that, you will get a different number. And sometimes what happens is that the management takes a view that, okay, the forfeiture rate, depending on the attrition, it will be much higher or lower. Yes, I think my client had 250 crores only what they had told. That unlisted company is 250 crores only. And listed company, I am not aware, but the unlisted company is 250 crores was what they had told me, Mr. Anil. Yes. So intrinsic value is the difference between fair value and the exercise price of an option. In case of a non-listed company, fair value shall be determined by an independent valuer. So when you get that ESOP valuation assignment, let's say for a US company, there'll be a 409A report which will be given to you by the client, which will cover the period in which the grants have happened. So then it becomes like a relying on the work of an expert, that guidance which is there, that you can rely upon that external valuer's report and do your accounting in your books of account. So intrinsic value is the difference between fair value, quoted market price, and the exercise price of an option. However, in the case of a non-listed company, fair value shall be determined by an independent valuer. Now, expense recognized using an intrinsic value method will always be lower than the fair value method, as time value is completely ignored in the intrinsic value method. So I have not seen much companies doing the time value accounting in their books of accounts. So companies following the intrinsic value need to disclose the fair value disclosure and impact on EPS if the fair value of would have been recognized for accounting expenses, but that practically does not happen. Okay, so this is as per Ind AS 102 that this needs to be done. So example, a company grants to an employee 1,000 stock option and an exercise price of rupees 50 and having a vesting period of 3 years. Current market price as on the date of grant is rupees 70. So the intrinsic value of each option is 20 rupees, 70 rupees, minus 50 rupees. Now considering a vesting period of 3 years and expecting all employees, all 1,000 options to vest. So they are not considering any forfeiture or attrition kind of a thing. So then what is the expense that they will recognize? So 1,000 stock options, 20 rupees in each. So 20,000 rupees divided by 3. So it becomes 6,667 will have to be recognized an expense in each of the 3 years. It's a simple straight line method. Now in here, for example, you'll also have to apply the date function. Because let's say the grant has happened, it's a listed company and the grant has happened on 1st July, 5th July, 7th July. And the expense has to be granted, amortized over 4 years. So in that case, in that quarter, the number of days that will be there will be like 7th July up to 30th September. So using the date function, you will find that number of days exactly and that you will amortize. So that is very important. That a lot of people make that mistake and the auditors also then find that as a point. So contrary to this, if the current market price of the share would have been 50, compensation expense will be 0 as the intrinsic value is 0. So a lot of companies, if you look at the ESOP thing, based on the listed, whatever is the share price as on the dead date, that only is the grant price also. As on the date of the grant, whatever is the current price, that is the exercise price. In that case, intrinsic value of the option is 0. But then when you do fair value accounting, it will be a non-zero value because there's an expected change in the stock price because that volatility and time period and all will be considered. So that I will cover in through an Excel example also. If you do it for a listed company, how that will happen. Now, how do you compute the fair value of employee stock options? So this is the whole Black-Scholes model. I mean, looking at this, it becomes a bit complicated. But Ind AS 102, 3 methods can be used to estimate the fair value: Black-Scholes method, binomial or lattice model, and Monte Carlo simulation method. Now, Black-Scholes is the most widely accepted method by the Indian listed and non-listed companies. So we will focus primarily on the Black-Scholes and the binomial. Monte Carlo, what happens? Monte Carlo, you're doing simulation of the stock price using a random function in Excel. You can simulate. So that will require certain inputs in terms of the past number. So that will be there. And in a binomial model, a more robust method and an iterative procedure that projects the stock price at each node in the tree, and fair value is estimated from node to node. So if you look at that, binomial is like this event happens, like if you look at the typical drill or oil well or not, it is that kind of a thing. So oil, yes, no. So like that, up factor, down factor, up probability, annualized volatility, risk-free rate of return, time to expiration, number of steps, and annualized dividend yield. So all of these factors will come into the picture, and the call and the put option can be valued. In the Black-Scholes model, there is ND1 STE into this formula. Mostly you will get Excel calculators. So the inputs which are there are very critical. So let's just understand when we'll see that in the Excel also. Stock price at the time T. So at the time of the grant, what is the stock price for that 6-month window? Most of the assignments that you will get will be, if it is of unlisted company, then you need to have like a 409 report or a registered valuer or a valuer report based on that stock price. The exercise price you will get from the grant letters. Now, risk-free rate of interest as on the date of grant. Now what is the risk-free rate of interest? It will be, what will be the risk-free rate of interest? How will you get, let's say in an Indian context? What will be considered in risk-free?
Government bond government bond.
Government bond, correct. Now, government bond also, how much will be the tenure of that government bond? Because that government bonds are available from 1 year to, let's say, 50 years. Then what will be the tenure which you will consider for your ESOPs?
About 10 years?
Normally 10 years we will consider.
No. So what
The tenure
you
of
do
the
is,
options. The tenure of the
yes,
options.
you have
The
to look at
vesting
the
period.
options. What is the weighted average time to expiry of the options? And you will have to align the risk-free rate of return for that tenure only. Okay. And that is number one. Understood? That if let's say it's a 5-year option, so 5-year GSEC will have to be considered in the books of accounts, means in this calculation, not 10-year or 1 year, because that becomes one of the points which is raised by the auditors also eventually, if you ignore that. The other thing that they check is that is it a discrete rate or a continuously compounded rate? So effectively it should be a YTM of the stock, because that is what the standard also says, that should be a YTM. So if I were to just give me a minute, I will just read out what exactly came as a point also in one of my recent assignments. So when you handle big six, it
should be
becomes
discrete. Should be discrete.
no, it should be continue. I'll just read it out, just a minute. Yeah. Risk-free rate of return should be continuously compounded in case of Black-Scholes. And then volatility and exchange rate needs to be changed in accordance with the time to maturity. It will be continuously compounded. Continuously compounded means you have to take the YTM of the GSEC, and that you will get through some databases. So normally on the website like in.investing.com, you will get generally the discrete rate. But if you're applying Black-Scholes, you have to get the continuously compounded rate. Otherwise, that becomes one of the points. There's not much of a difference, but theoretically, yes, they are right when they say that, okay, Black-Scholes model requires continuously compounded rate. Now, annualized dividend yield, that is also a thing. In case of a listed company, in the Black-Scholes model, you need to have the dividend yield also plugged in. In an unlisted company, you can take a view that, okay, we are still in the growth phase, there will be no dividends. But in a listed company, there is a past pattern for the dividend yield. And accordingly, that nominal dividend yield has to be considered. And then annualized volatility also. Now, this volatility also, the period has to be aligned to the life of the option. Now, how do you arrive at volatility? For example, if it is a travel company, then what you can do is that in the Indian entity, I am not aware of the Indian much, but yeah, Yatra, Make My Trip. So in the Indian context, Yatra will be listed, and then Ease My Trip will be listed. Abroad, Make My Trip will be listed. So you'll have the stock price history. Based on that stock price history, you can do the annualized volatility. How will you do that? Every day, the movement which will be there, daily stock price movement, that you will analyze using square root of 252 because there are like 252 trading sessions. So then you get the annualized volatility. And then time to expiration will be T minus T. So that is how the risk-free rate of return and the volatility will have to be aligned to the time to expiration. Binomial model, not much use, but this is how it is. Now, Black-Scholes model, the exercise period is only 1 point of this exercise is assumed. Here, at each node in the tree, you will assign a probability. Assumptions are considered constant over the expected life of the options and works well with European options, as an early exercise of the option is not modeled. So practically speaking, most companies will use Black-Scholes model only. Now, data and assumptions, ESOP valuation require several assumptions to be used, which in turn might require however, Indian accounting standards require an option pricing models to consider the following inputs. Grant date, exercise price, term of the option, we have discussed this. Yes, this is also what we need. That in terms of the data, we want the documented ESOP scheme and we want the active ESOP, employee ESOP data as on the date of the grant. And the assumptions will be expected volatility of the option, expected dividend yield, attrition rate, annualized risk-free rate of interest, and expected number of years to exercise from the date of the grant. Okay.
So here
Now,
I
for
have one
example,
point of concern, Sarji. So this documented ESOP scheme of the company, what are the critical aspects one has to consider from this, or what are the key parameters that has to be looked into when we are considering for Black-Scholes?
So from a practical perspective, one thing that you need to see is that what is the minimum and maximum life of the option. So they become exercisable the moment they vest in you, right? Now, after that, some companies, the policy says vesting plus 10 years is the maximum life. Okay,
Yeah.
so then what you have to do is the weighted average vesting period you will consider. Let's say it comes as 3.2 years. And then 10 years post that. So 3.2 years plus 10 by 2, which becomes 8.2 years is the min plus max divided by 2.
Okay.
So one thing that we need to see from there is that the other thing we see is that there are some companies which have a clause that, okay, the moment the employee leaves, even if the shares are vested, they can happily exercise it over the next 10 years or whatever is the remaining point. But some companies are like mandatory, you have to exercise it then and there, otherwise they get forfeited in 1 month. So that kind of thing also will need to be coming into the picture, because if you remember, we had considered the most important thing was that are expected to ultimately vest. So accordingly, that comes into the picture and we say that, okay, from the documented ESOP scheme of the company, this is what will come. And then active employee data. And this is one thing in most of the companies, the ESOP data will be handled by the HR. You will be dealing with the finance guys. This data will come to you from the HR. And then they kind of technically want to maintain Chinese walls between the two companies, two departments. So that becomes the thing. So yes.
Correct. Got it.
So the ideally in your final report, that column on the employee number or the employee ID, that you should be very careful that that should not somewhere remain in the workings.
Got
okay. So assumptions, expected volatility of the options, expected dividend yield, expected attrition rate, annualized risk-free rate of interest, and expected number of years to exercise from the date of the grant. So these are the assumptions that will be there, which we have already covered. So first, so let's say there is a 70 rupees is the exercise price. Current price is 100 rupees. Vesting period is 2 years. Attrition rate. So we talked about this attrition rate becomes very crucial. Number of employees being 100. And employees, ESOPs to each employee is 1,000. So it becomes like 1 lakh options have been granted. So 1,000 into 100 into 0.9 to the power 2. Because what you're expecting is that attrition will be such that 10% people leave every year. So in 2 years, you will have 81% of the people only remaining. So it will be 1,000 into 100 into 81. So that's the number of options that are expected to vest as on 1st July 2023. So what is the total expected cost to be recognized? It will be 81,000 into, and what is the delta? Face value of the share is 10 rupees. As per the Black-Scholes model, it is 40 rupees. So if you do the fair value method, it is just the difference between them. Okay.
In the vesting period, sometimes they give the cliff period. So is the standards or the guidelines, how does this cliff period to be considered or incorporated in the vesting
Very
period? It should
simple.
be.
So if the cliff period is 12 months, so normally it is like there is a cliff of 12 and then it becomes 1/48 in each of the months. So then what will be your weighted average? For the first tranche, it will be the time will be 13 months because 12
Okay.
month is cliff and then
Okay.
1 month, 148. Then the next installment will be 1/48. It will be 14 months, 15 months like that, 49 months. So that cliff will be covered like that. Okay. So that is how it will be. And then expense, how this will be recognized on a straight line basis over the vesting period. So in each of the years, it will be divided by 2 minus whatever is the actual thing. And so therefore the calculation will come. So this is the compensation expenses for the year and the cumulative expenses that are recognized. So compensation expense for the year is column B and then cumulative expenses column C when you are cumulatively adding all of this. Okay. What will be entries which will be there? Employee stock option expense account debit in the first year, like we got 1215, which is 3240, which is our number which we got 3240000. Okay. Into 0.75 divided by 2. Why 0.75? Because it was granted on 1st July. So period remaining was 0.75 and vesting period is 2 years. So accordingly, I will do it here. And then it is 1.75 divided by 2 minus this. And then for the third year, it becomes 2 by 2. What is the cumulative period which is completed up to this period? And then minus whatever has been cumulatively recognized in the previous period. So that's how the cost will be incurred. So it's a time period method. That 1st July
In
to
this case,
31st March, 0.75 years. Then 1st July to 31st March of the next year, it is 1.75 years. And then then there is 1 quarter which is remaining. So 1 quarter charge will come in the final year. And every time you'll have to say that what is the cumulative expense that is recognized up to the previous period. So it's like bridging the gap that, okay, as on this date, the value must come at this number. Whatever is the number that has already been recognized, only the delta we will recognize in the books of accounts. Now, what will be flow of entries? So the first year ESOP expense account will be 1215000, second year 1620, and the third year 405. Now, if the options are exercised, what will happen? 70 rupees per option will come into the bank account, and 40 rupees you will knock off from the employee outstanding reserve account because that was the intrinsic thing. So then to the then how much? 10 rupees is the face value, and then remaining becomes to share premium account, the balance account. So you are issuing basically shares at a premium because your face value was only 10 rupees. So whatever is the balancing number that comes as the share premium account. And then if the employees have for example, they have left or etc., they have not exercised etc. So then you will knock off the employee outstanding reserve account debit to the general reserve account. 6,000 into 40 is 2,40,000. Okay. Now graded vesting. Now that is a more complicated thing. So straight line method is relatively simple life. But graded vesting mein what happens is that as if with a graded vesting schedule, 25% vesting each year over 4 years are treated. In essence, like there are multiple grants and fair value of each grant is amortized over respective vesting periods. Separate grant approach. So this is technically, if you deal with the big four, they will try to get this separate grant thing. So what they will do is that the cost in the first year will be 100% of the cost related to 25% of the options. And for the next year, it will be 1 by 2. And for the next year, third year, it will be 1 by 3. And whatever is vesting in year 4, it will be 1 by 4. So the tranches are made like this. So 25 full in the year 1, I'll have to recognize because that's the first tranche. The second tranche of 25 will be 12.5, 12.5. The third tranche, it will be 8.33, 8.33, 8.34. And from the fourth tranche, it will be 6.25 each that will be there. for the purpose of net worth, we need ESOP outstanding reserve along with other reserves. Is it a free reserve? No, it's not a free reserve. I think ESOP accounting reserve. Now, that think we'll have to check with the exact definition which is there. I have not come across this situation in the past. So this vesting tranche wise, this is the thing that you need to do that. For example, if there are 16 tranches, accordingly like 1/16, theoretically, I think it is not a free reserve. So it will not come in the ESOP thing, in the net worth thing. So 25 fully, the next year tranche, 1/2, 1/2. Here it is 1/3, 1/3, 1/3. And here it will be 1/4, 1/4, 1/4 and 1/4. That becomes the graded vesting thing. So approximately 52% of the total cost will be expensed out in the year one. So there is a guidance note on accounting for share-based payments issued by ICI and Ind AS102 as per graded vesting recognition of expense. This needs to be done as per separate grant approach. But earlier, accounting for share-based payments when ICI had issued in 2005, employee stock options with a graded vesting was accounted either as a separate grant or as a single grant. You had that choice. In that option as a single grant approach, the cost is recognized on a straight line basis over the full vesting period. So just 25% of the total cost will be expensed in year one as compared to 50% of the cost if you are recognizing in the separate grant. So what is basically doing? You are doing here, you are accelerating the charge to the books. Now this always becomes a bone of contention. The company will want a single grant approach. That was earlier there, but auditors will always insist that there should be a graded vesting method. And accordingly, the total cost recognized over the 4 years remain the same under both the approaches. So over the 4 year, it will be the same, but in terms of time value of money, what will happen is that it will be different. So accounting treatment as per Ind AS 102, if it is an SAR, okay, as a cash settled payment basis, it is valued at each balance sheet date. Modifications do not change the valuation approach as they have to be remeasured at each balance sheet date. Recognition principle, any change in fair value is to be recognized in the P&L. Now, the difference between ESOPs and SAR is that it is just a stock appreciation right that needs to be there in the books of accounts. Okay, ESOP is an equity settled payment base. So one-time valuation at the grant date, balance sheet date related, exception in the case of modifications to the plan. So one-time valuation is on a grant date, and if there is a true up, so some companies talk about true up and all, but practically I have not seen a lot of that actually happening. So that will be there. So again, like this, we have discussed in terms of arm's length transaction, knowledgeable, willing parties, etc. The fair value mostly from a ESOP perspective, Ind AS 102 says fair value of share-based remuneration schemes, whether ESOP, whether SAR. However, they have not recommended any method of valuation, whether it should be Black-Scholes, whether it was binomial, etc. They have practically, there are 3 methods that are implied. So as defined in Ind AS 102, Black-Scholes model is the most popular method. Binomial or Monte Carlo are not as popular because of the very complexity that is involved, cost benefit, and every time then all the assumptions in a Monte Carlo are subject to challenge. So valuation approach is different, but only the strike price, underlying price. In SARS, it is slightly different. So all option price must consider all of these 6 things which I have already considered. Exercise price, life of the option. So life of the option, in case there is a cliff, it will be like 12 months of cliff. So the first tranche will be 13 months. Then the second tranche will be 14 months, etc., etc. Okay. So that will be the weighted average karke the life of the option. Current price of the underlying shares. So in case of a listed company, it is very easy. You just have the current price. In case of an unlisted company, 6 months for that period, we get some report, 409A report in case of a US company, etc. Then expected volatility of the share prices. So in case again from a listed company, now the thing is that you can take it from that company volatility. Now let's say that company is recently listed. You can take off the peers. So make my trip, ease my trip, and then Yatra, all of that you can take. And risk-free rate of interest for the life of the option. So what is the risk-free rate of interest? That also can be considered. So knowledgeable willing, that is a theory that will not be there. Now under US GAAP, what will happen? Now there is a slightly complexity means broadly it is the same. But there if you have that leverage thing and all, there it becomes a more problem. Accounting treatment for stock rewards, measurement principles, and the valuation approach will depend on whether the assets are classified as equity or liability. The award will be classified as a liability when if the award is indexed to external factors such as a price index or the metrics of peer companies rather than company specific factors. So example, if the whole index of the IT stocks will move itna or the price index, for example, CPI index is this much. So it's not related to the company, but rather to the larger thing. If there's a repurchase thing or requires the employee to pay the employee cash, then it will be a liability. Liability classifications are mostly rare. It will be classified as an equity. Now, what is the ESOP accounting there? Again, there also it is the same thing. Like, so there is not much of a difference. Report is obtained on the date of the grant and used every year, same value. Any changes in valuation is not considered. Used every year, same value. So that in case of a listed company, it is easier. In case of a unlisted company, normally they will obtain the report. But yeah, that is a practical reality because it depends on how much is the charge that the CFO wants to take in the books also. That is also a practical reality.
No, my doubt is we'll get a valuation report as on the date of grant. If the policy is for 7 years, we'll arrive at what is the charge to P&L account. We'll use on a SLM basis. So the fair value of the scrip as on the date of grant and also as on the date of exchange will be huge difference sometimes. So P&L account charge will get only valuation considered as on the date of grant, which is very minimum. Assuming that on the 6th year, the fair value must have been 10x. So is it correct by understanding?
And it also says it is as on the date of the grant only, no?
No, it's okay. I'm asking, is it fair? Because as on date of grant, price may be say 100 rupees. And the 6th year, 7th year, when they're due for exchange, it may become 700. So that change in the value from the date of grant and date of
Right.
strike price, in the sense every year. Because every charge goes to straight line that charge. So
Please tell me one thing. For example, why are ESOPs given? To compensate you in return of salary, in lieu of salary. Now in
correct.
2023, if I give you a flat in MG Road, it will cost 5 crore rupees. But the condition is that you must remain in the company for 5 years.
Agreed.
So after 5 years, when that flat actually comes to you, it is worth 20 crores. So if you were to give salary to that employee, it will be 5 crores only, na? And that compounded after 5 years and became 20 crores. That is a separate thing. But it is in lieu of that salary. And hence, as on the date of grant only, it will be there, no?
Agree. As in the, understood. What I'm saying is, as in the date of grant, if you take same example of M0, as in the date of grant, maybe say 5 crores. As in the date of exchange, maybe 20 crores. So on the 1 year before that, if you see what is getting benefit is 20 crores, not 7 crores. So I know that you were saying.
When did he give the services to the company?
Yeah, every year, 6th year, you give every year.
No, but the condition is that when he rendered service, when he was given the option granted. Grant is the condition which is considered here. If he had been given salary also, it would have been for that period only, no? So this, you have to take a view that this is something like proxy to that.
Agreed.
Grant.
Same example, just say it has been a salary. On the 6th year, you will get 200 times of what is got salary on the first year. So, but charge is going down the same, whatever agreed.
That is only the accounting. Accounting will go on as per the grant date, and the benefit derived is the
you can do a true up if you want. So there are some companies which do a true up.
Kaushik, according to him, there is a huge flaw in this. We saw talk so much of fair value. you are calculating a fair value as the date of grant, which is very less. That you are amortizing for 7 years. So it means that every year you will contribute. So on the 7th year, first year what he gets a benefit is very nominal amount, but on the 7th year when he getting is a huge amount. So assuming that if the valuation, the same report if obtained and as in the every year, if you charge of total charge minus whatever charge, so that gives fair value. I don't know. This is my view.
So
Assuming
actually
that
what
we
happens is whatever the appreciation that happens, that will not come to the company. It will happen. So okay, I'll tell you, if there is a cancellation of option, for example, if the company does a buyback, in that case, the expense that was actually recognized. Okay, I'll just show you. Okay, since you are curious to know this. Yeah. So normally what happens is that yeah. So this is how it will be there. That what was the payment that was made to the employee on the settlement or grant date, and what was the fair value of the equity instrument that was granted. As then and therefore whatever is the excess, so that you will have to now recognize an expense in the books. I think this will address your point. So what you are saying that okay, these were the units that have been granted. I had only recognized 6 crore 84 lakhs in the books of accounts. But when I purchased them, the fair value had increased much more based on the latest funding round. Okay.
yes.
Or latest discovery. So the difference which has been paid to them, that will be recognized back in the company's books of accounts as an expense. So that is also as per the Ind AS that is told. And I have practically done this, so I know how this kind of things happen. So you understanding whatever was the cumulative cost for these options which were bought back as part of a larger round from the employees. So the only 6 crore 84 lakhs had been recognized, but since the company that was the payment 6 crore 84 lakhs, the company had only accounted for 133, and hence the excess that had to be recognized as an expense is 550.
When we need to recognize the 5 crores?
In the P&L for this year, when you are actually doing the cancellation of the options.
Okay.
But if there is no cancellation, this accounting is not required, and the books will continue to remain in the cost
Because
of 1 crore.
it will be a secondary transaction. The company is actually not bothered.
Correct.
So
So it does
one
not
of our
get
client,
factored in the books of accounts.
The secondary transaction company only has to do a filing of a SH4. It really does not, and the SH4 is also actually not filed. It is just franked and kept. So there is company does not really bother whether you are doing a secondary at 400 crores or 1000 crores. So when the company granted, if the fair value was 50 crores, that is what the company bothers, no? So mostly there will be secondary. If the company itself buys back, then the challenge will be there.
Thank you.
Okay. Now, since we opened the Excel, so this is in case of a listed company, it becomes far easier. So what happens is that market price is easier there. So vesting date, grant date, vesting date after 12 months, options to vest 265. So then, yeah. So exercise price is the actual exercise price which is there as per the term sheet. So here exercise price is actually more than the market price. Okay, so the intrinsic value of the option is actually negative. So market price is 1315, exercise price is 1510. So the intrinsic value is actually negative, but fair value will be there as per the Black-Scholes model. So the term of the option is 10 years. RF return, this is the continuously compounded GSEC rate. Volatility we have calculated using all the peers. Expected dividend, we had talked about expected dividend. So that also comes into the picture 400%. So dividend per share is 40 rupees. 10 rupees is the face value. So dividend yield, it is 40 rupees divided by the current market price. So this is how we will practically implement it. So then intermediate computation will be the present value of, so this is basically Black-Scholes. So present value of the stock ex dividend, present value of the exercise price, cumulative volatility is basically 10 years, 46.23% into square root of to the power 10. It will be a cumulative thing. Proportion of the stock exercise price. So then you do this norm distribution thing. So these are all formula driven. Proportion of the exercise price PV, that becomes part of the call option. So the call option value will be this into this plus this into this. So present value of the stock ex dividend multiplied by the proportion of the stock present value plus present value of the exercise price multiplied by the proportion of the exercise price present value. So this becomes there. So options that are expected to be vested. So this will be, for example, 265 options and I'm expecting 0 forfeiture rate. So it will be this into 1 minus 0 and again to the power B minus, so B6 minus A6, which is the vesting date minus the grant date divided by 365. So then therefore the total cost will be this into this. So this is one practical aspect that you need to see and see. Now then we will amortize this over the period based on the number of days. So this date minus the grant date. So that formula you will set and this will be amortized over next 5 quarters, not 4 quarters, although it is 12 months because of that thing that 31st March falls in between. So there'll be effectively 5 quarters. So this is how practically it is done. Now, one thing a lot of people do for, let's say, fair value, since the discussion is happening. I think I have covered it later. Yeah. So this is very important. So let's say the company has actually had a cap table which has got multiple aspects here. Means multiple type of instruments are there in the cap table. Preferred stocks are there, warrants are there at different strike prices, and because at different points of time you had given different preferred stock and preferred warrants, and then common options at different strike prices were given. So accordingly, these are the different number of shares in the cap table. So that's called OIP, original issue price is there. So original issue price will be there. Then future liquidation preference per share. So in some cases, what will happen? You will have an LP also, which will need to be factored in. So why I'm saying this, the objective here is the fair value of, it is a common stock. So to most of the things, what will happen is that the company will have done mostly CCPS issuance because that is the more popular method of issuing the, doing the fundraise. You are doing Black-Scholes model for accounting for fair value of grant of a common stock. So therefore this common stock, what is the implied fair value? So let's say if the CCPS has happened at $10, what is the price at which, what will be the implied price for a common stock? Most of the people, they assume just 1:1 and just assume that, but that is wrong. In case this assignment needs to be really done properly, you have to do this OPM backsolve method and you will do the equity valuation calculations accordingly. Like if this is the dollars, so preferred stock will be there and then the warrants will be there. So you'll have to basically make all the steps in this model and how they will be depending on the seniority, how the value will be allocated. So that will be there. That needs to be considered. And you're getting this. I mean, this is slightly Latin and Greek if you have not done this in the past. But what we do is that we create that in. So let's say if the enterprise value is $2 billion, the first $500 million will accrue only to the Series B preferred stock because of the liquidation preference that they have. Then in terms of seniority, who will come? Like that. So in the first option, so in the first breakpoint, you will see that only this 100% gets allocated here. In the second breakpoint, this comes. In the third breakpoint, this comes. Fourth breakpoint, this comes. Like this, the whole thing will come. And accordingly, you will do the breakpoint calculations that 100% will get allocated here, 100% will get allocated here. And the net output from this whole exercise will be that using Black-Scholes model and all, the breakpoints will come. And this is actually the implied thing. So if the preferred stock latest round funding has happened at $13, which means the implied stock option as per this is 8.92. So if you don't apply this, normally the CCPS conversion is 1:1. You will say, okay, the CCPS, the latest funding has happened as 13.23. Company will issue a valuer. So that becomes a level 1 input because it's much better than any valuer's report. So, but it is not 1:1. So there is like a 13 and 9. So it is 4 divided by 13 or 35% gap between preferred stock and common stock because of the differences in liquidation preference, etc., which will be there. So this is the kind of thing that you should actually prepare for some of your clients. Now, this accounting entries we have considered. Cancellation of options, which you are considered. What is the theory? As per the para 23 of the Ind AS 102, vested ESOPs, which are not exercised or forfeited after vesting, such expenses of vested ESOPs will not be reversed in the P&L account. Employees outstanding will be transferred to general reserve. So that is what we had done. That what is the delta is there. We have done this. Now this is almost the same things. We are getting the same thing. This we have considered. Okay. So now I'll just take you through some Excel points and try to show you. This we have covered. Employees covered, not covered. Now this some people have a confusion that what does ESOP, it does not cover independent directors or directors holding 10% capital. So please remember that if that kind of a thing comes, you need to know. And now this, what is this phantom stock? There is only appreciation, only phantom stock. There are companies like DLF, Birla Sun Life, Bajaj Alliance. They have given these kind of stocks. Only some trigger event happens, then these you get a future cash bonus equal to the value of defined number of shares. No legal ownership of share transfer takes place. They will be convertible into actual shares if the defined trigger event happens. So accounting for phantom stocks also, sometimes those assignments will come to you. Okay. And then RSG and RS. So it is broadly the same thing, RSU. So now I'll show you the Excel. Some part I wanted to show you in my Excel also. Now, yeah, first we will see the Infosys annual report. If you are doing it for a listed company, so what you will see is that all of these disclosures you will have to make and give to them. Yeah. So like they say that how much is the ESOP employment on this is all in the graphicals, but as per the standard, what you have to value, we are just going by that. Yeah, this is what will be disclosed in the books of accounts. Like which is the scheme which is there, RSU. What is the shares arising out of these options? If these options were to exercise, what is the shares arising out of that? How much was granted? How much was exercised? How much was forfeited and expired? And accordingly, what is the outstanding at the year end? And what is exercisable at the year end? This will be there. And what is the weighted average exercise price? That has to be calculated. So this disclosure will have to be made for each of the separate tranches which is there. So weighted average price of the options exercised under the 2015 plan was ditna for this period. And then the summary of the information will be what is the range of exercise price? Rupees 0 to 5, then 450 to 630. Under which plan? Then again like this thing, and then how much was cash settled options which were there? What was the carrying value of the liability? How did we calculate the fair value of the awards using Black-Scholes model for time and non-market performance based options, and Monte Carlo simulation for TSR based options, where there is a condition related to performance which is there. So the inputs to the model include share price, exercise price, volatility, dividends, term, risk-free rate of return. Expected volatility during the expected term of options is based on historical. Now that is the thing, expected, but based on historical of the observed price. So recently we are doing valuation of a put option also. So I had that confusion that whether that volatility should be some forecasted INR USD volatility or past. But then it was settled that it is based on the past only of the publicly traded equity shares during a period equivalent to the expected time. Expected volatility have been modeled based on historical movements in the market price during this period, and then correlation coefficient between each peer entity and indices also is considered. So then they give that whole thing, that what are the assumptions that are used. Expected life of the option 1 to 4 years. Expected dividend 2 to 3%. Risk-free rate of return, this to this, and weighted average. So all of this. So accordingly, you will do the disclosures in the books of accounts also. Okay. That is one. And just opening the Excel. This one. Now what happens here is, so the net output for the ESOP will be like number of cumulative options. What is the cost without attrition? Like say 25,000 options. The cost is 500,000. This is like in dollars. This is as per the US GAAP also. So attrition that will be expected. So now you can see that how critical this attrition number is. That if it is 20.62, instead of that it was 15 or 25, this whole accounting charge will change. So then you have the attrition adjusted cumulative cost to be recognized here, less the cost recognized till March 22, and therefore the expense to be booked for the year is 256. Okay. So then we do all of these disclosures, weighted average fair value, weighted average exercise price, what is the option, and hence outstanding at the beginning, granted during the year, exercised during the year, cancelled during the year, options outstanding at the end, vested at the end, unvested at the end, exercisable at the end of the year. So this whole question will be there. Black-Scholes calculator, this is very simple. Mostly you will get it wherever you want. Like this is like 409A report, which is shared by the management of the company. So you have all the share price, exercise price, TTM, time to maturity. Now you divide that in years. So now based on two different tranches, so there are some like there is one grant in which there is a 12-month cliff, and hence this is the weighted price. In some it is there is no cliff, so it becomes a separate. So time to maturity will be different. Now this free rate of return, this is the US. Now here we made a mistake also. We had first taken 10-year bond yield, but ideally it should be 6.5 or 5 years because it has to match with the rate of the return. And then volatility again. Now some people take it just on the basis of Ashwath Damodaran. Now that is also there. In some cases there is just no comparable available. But in case there is a listed peer, you will do all of these calculations. Okay. Now, fine. So, happy to answer if you have any other questions from this. Yes, any questions that yeah, and so yeah, one discussion point, which is my last slide. Before that, if you have any questions, please tell me. So this all we have covered. SOPs I could have covered, but problem is that this is getting recorded, so I don't have any dummy data. I don't have, so that I cannot show you. Yeah. So these will be the practical challenges. How to determine attrition rate or lapse rate from a practical perspective. Shall we consider only all left employees only or only forfeited options? How to consider attrition rate of the vested ESOP employees? And then expected term on the option, that is very simple. Amortization or expense with monthly or quarterly vesting. So how many separate grant method mein how many grants? So we had one discussion very recently where the auditor said, okay, there are 48, 1 by 48 each year after 12 months cliff. So then I told them that in a separate grant approach, then for each of the options granted, you'll have 48 line items. So then practically we took a view that that was not possible. So then you can just take a weighted average 1 by 48 into 13 plus 1 by 48 into 14 like that. Come to T and then take it. And then ESOP fair value when benefit is guaranteed, etc. All of this is there. So any questions that you have?
So is the reporting standard across all frameworks, reporting frameworks, or it kind of differs from one framework to another?
No, so the disclosures as per ASC-718. So the example of Infosys that was there was under Ind AS. Now, as per the US GAAP, again, employee compensation. So it will be the same thing that we showed in the Excel, that opening. So broadly, it will be the same. Under the ASC-718, that separate disclosure is required, which we had considered here, right? I will just, we had just seen that. Opening plus granted during the year, less forfeited, less cancelled. And then that whole calculation is there. That needs to be disclosed. So that's a separate disclosure as per ASC-718. That is
The
there.
valuation is more or less the same across all the frameworks,
Yeah,
but
because
reporting,
Black-Scholes model, if you apply, it will be the same.
yeah, only reporting is depending on whatever is the requirement as per the framework. Is
Yes.
my understanding correct?
Yeah, and in US GAAP, if that liability or equity, that part is there, that we had just seen that, right? That if it is indexed to an external performance and it is the factors based on which you will get this performance are not internal to the company, it will be recognized as a liability and not as an equity. In that case, if you do ASC-718, there are lots of complications which will come into the picture. If it's a plain vanilla employee stock option scheme, which is not conditional in nature, broadly, it will be the same, and this kind of disclosure which will be there as per US GAAP will be required to be given. That reconciliation, this becomes a challenge because last year, what was the option outstanding? If you normally you see the softwares, Kata and all, whoever have these softwares, you'll generally see that some of the glitch or the other happens that the last year closing is not matching with this year's opening. And then how do you build these kind of tables? So the best method is that as per the audited, whatever is the last year's closing, that you take as the beginning of the year and try to see where you can make the reconciliation happen that the outstanding at the end of the year matches. That is there. I just wanted to show you this ESOP thing, but okay, I'll just show you on a broad level how that happens so that just let me show you something. So this is how this probability will be calculated. We will just show you this. So normally what will happen is that, let's say the condition is that the revenue is greater than 1000 crores or the revenue is greater than 1500 crores or the revenue is greater than 2000 crores. How do you calculate the probability of this event happening based on Monte Carlo? So what will happen is that based on the past events, past trend in the company, you will calculate a drift, which is the past year thing divided by 2 and the shock. Okay, drift and shock. And then you will assume a standard deviation. So the shock will be that assumed standard deviation. Now you see this random 10,000 numbers that are granted here. Norm inverse, norm dot inverse, random 0, 1 kind of, you calculate 10,000 probabilities of this event happening. And then what do you do? What will be the revenue here? So there is this formula that this is the forecasted last year's revenue, P&L, this is the last year's number into exponential function, Rev 25 Monte Carlo E2, which is the revenue growth, the drift, plus the Rev 25 Monte Carlo E3, the shock, into Rev 25 Monte Carlo D7, this number. You're seeing this formula is thoda sa complicated, but this is how it will be, that you have from the past data a growth rate which is there, which is exponential growth. I mean, you will use the ln function, not a CAGR number. and then you will calculate a drift, you will calculate a shock, you will compute 10,000 random numbers, and based on those 10,000 numbers, you will compute the revenue for the next, for each of these 10,000 numbers. So then what is the operating margin? Again, you can calculate that whatever was the historical operating margin, because one of the conditions is can also be operating margin. So whatever is the historical operating margin, there again you'll apply this exponential function. So last year's operating margin multiplied by the drift exponential into drift plus E2 plus E3, drift plus shock into, so it is drift plus shock into this random number. This will be there, and therefore the MC check will be, this whole thing will be there. So then the standard deviation is this. Probability that this number will be, you have to just use a countif function, that of these 10,000 values, how many was the events that the probability is more than 1,000 crores. So if the management milestone is based on revenue, you will see that it is mostly covered. If it is 1,500 crores, the probability is 89%. So 89% of the cost will have to be recognized in the books of accounts. And if the revenue is more than 2,000 crores, you see it falls down to 53%. So this is how, when you are like operating in an area where you have no clarity of the future, you just have the historical growth rates, but the management stock option is so designed that it is based on past performance, you will see that that kind of a thing happens. What is the question? Yeah, there is one question. Just a minute. So what is the question? Wait, I will share the screen. The question is, feedback form is there. Sir, assume the company has 6 grants over a period of 2 years. To calculate the accounting or Ind AS, we need to do the exercise for each grant separately. Yes, separate grant approach. Yes, 6 grants over the period of last 2 years. Each grant will have to be separately accounted for sure. Okay. So you can please follow me on LinkedIn. I sometimes write about valuation as well. So valuation financial modeling is what I do. So where is my LinkedIn ID? I can just show you. Yeah. So this is my LinkedIn ID. You can just check Anurag Singhal. Okay. Thank you. Shall I exit, ma'am?
Oh, no, sir, just give us a moment. Just give us a moment, sir. We have some closing formalities.
Oh, acha. Oh, these forms have to be filled, right?
So that is for the participants, because that is we generally want to improve our program by obtaining feedback from the participants. So you'll see that there is a a memento that is displayed that will be couriered to you, because we thank you for your valuable contribution to our association by speaking to us on a Saturday morning.
Thank you.
Sir, I take immense pleasure in thanking you for your valuable contribution, sir. I'm sure all the members here are they acknowledge the fact that you have shared your experiences and mostly the practical approach of handling this. So we thank you very much for the same. And sir, I'm very sure that there will be followers on your LinkedIn profile too.
That's and what exactly did you find? So if anyone wants to share, like we spoke for 1.5 hours, what was that one takeaway which you found most relevant? If anyone would want to share, that will be for my understanding also, it will be useful. That what was that one aspect of the calculation that if anyone would say that was new or that was something which was the concept got cleared. Anyone?
Yeah, maybe it's the risk-free rate. It should kind of correlate to the life of the options. Maybe that was one of the thing. Otherwise, generally it is the standard of 10 years.
Yes, yeah, we take 10 years.
So those are some of the things that were
And
very, very
discrete or
relevant.
continuously compounded, that also please remember, in case you're using Black-Scholes, it has to be a continuously compounded rate.
Continuously.
You have to take a bond yield, not the normally quoted rates on in.investing.com. Okay.
Yes, sir. Sure. I'm sure, as we get into this, as we dig deeper into this, have a better understanding, we'll always try to better the valuation reports, I guess, by considering the various inputs.
Sure.
Yeah. Thank you very much, sir, and have a good, weekend. Thank you all the participants. On behalf of BVA, we thank Mr. Anurag Singhal for his valuable contribution and his time this morning. Thank you very, very much.
All right. Bye-bye.
Bye-bye.
Thank you.
Yeah.
Bye. Thank you.
We hope to have a live session, sir, in the near future, practical session like a residential program. That if that can be done, then we will have some, added value. Thank you very much. We'll exit the meeting. Vijaya, if you can just close the meeting. Thank you, Vijaya.